Gold has had a tremendous run up from its lows a few months ago, and now it's trading at $1,900 an ounce. This is really good news for gold investors all around the world, but can this level be sustained? Well, that is a question we'll be exploring in depth with Gary Wagner, editor of thegoldforecast.com. Gary, welcome back. Always a pleasure to have you on the show.
It's great to be here. Thank you, David.
You've been calling for this run up for a while. Well, you were bearish for a while, and then when the trends turned, you had called for a reversal back up to $1,900 an ounce. Tell us about this move we've seen in the last couple of weeks. Substantial move up, very fast in velocity. What drove the price up, Gary?
Well, I think a lot of it had to do with dollar weakness. And of course, the question then becomes, why has the dollar become so weak? And right now, we're still grappling with the fact that we're coming out of a great recession, so to speak, and there was tremendous amounts of capital that had to be expended to get us out of this and kind of to rekindle or reignite the economy. And to do that, the fiscal spending was $4 trillion last year. Biden began with about $2 trillion this year. He is now proposing another $2 trillion in infrastructure, although the Republicans are coming back with $1 trillion, and the thought is they're going to meet somewhere in the middle. However, there's kind of been a breakdown in that there is now talk about the Democratic Party in the United States pushing this bill through without Republican support. And if that happens, of course, that will take the dollar even lower. As we spend and as we create debt, it has to put internal pressure on our currency. And that's what we are witnessing.
This proposal has been not yet finalized, of course. Like you said, the Republicans are counter-proposing $1 trillion. So why is it that the dollar is reacting, I guess, prematurely? Is that the correct word?
Well, you can always look at a market that has good liquidity, active traders is forward thinking. So we saw stocks really take off before it was their time. But investors and traders are looking 3 months down the road, 6 months down the road, and what effect that it will have and where a particular stock or commodity or currency might be at. So we're seeing a precursor to market sentiment shifting, and that's the key. The big move in gold was a major shift in market sentiment from bearish to bullish. And right now, once we broke above 1900, I believe that price point is destined to become support. Now, we traded below it today. We also traded to a new high, 1920, I believe. And so we've got upward momentum. And on a technical basis, there really isn't any strong resistance point until about 1965.
So you would be long gold at this point, Gary?
We are long gold at this point. What we did is we were in the former most active contract, which was June. We pulled profits out. We got in, I believe, at 55, out at 97.50. And then we got into the August contract last week at 1900. And of course, we saw it run up throughout that. Now it's kind of back hovering right in that area. So I believe that there is more room to the upside.
Summer months have historically been a little bit quieter in terms of trading volume. Have you noticed that right now in terms of the volume in some of the commodities you're following?
Well, you've had upticks in all of the commodities. So you are getting lighter volume. These are the summer months. And of course, you get a lot of traders that aren't as active as they are when it's not summer. However, you're still going to see a reaction to fundamental events as they unfold. And that's what we're seeing.
All right, let's go back to the U.S. dollar for a minute. You're right to call upon the infrastructure bill and its effects on the dollar. Let's talk about the interest rate side, because as you know, interest rate differentials vis-a-vis the U.S. versus other countries is also a big factor. Now, the U.S. 10-year yield, I'm checking right now, is around 1.6%. So it's oscillated around that level for quite a while. Where do you see rates headed for the foreseeable future, Gary?
Well, my personal sense is that we might see slight upticks in the 10-year note. However, in the long term, as long as the Fed maintains a very accommodative monetary policy and keeps their Fed funds rate at 0 to 25 basis points or 0.25%, you're going to have interest fairly stable and low. They don't want to jump the gun as they did in 2008, where they ratcheted up interest rates very, very quickly. And they took a lot of heat for that. They're being very, very cautious about that. Now, the interesting thing is when minutes were released from last month's FOMC meeting, there were voting Fed members that said maybe it's time to talk about tapering. Maybe it's time to talk about raising interest rates. And the key right now is that Chairman Powell has maintained a mandate of low interest rates and letting inflation run hot. And that's another element that we haven't really brought into this recent move in gold. A CPI showed an annual rate of 4.2%, and that's the highest we've seen in some time. So it is this combination of factors that has really moved gold to higher pricing.
Okay. Now, I'm just eyeballing this, Gary, but let's leave the dollar chart up for a minute here. If you compare the dollar chart versus the gold chart, I would say, just eyeballing those two charts, they're pretty much inversely correlated. Now, we've talked a lot about the gold's correlation to other variables on the show before, you and I, real interest rates, inflation, nominal yields. The dollar correlation with gold is not something that we've talked about a lot, you and I, recently. Would you say that this correlation is strong right now, or do you think there are stronger variables out there that will tug on the gold price?
Well, the fact that we trade gold as a pair against the dollar, if the dollar goes down, gold has got to have that reciprocal uptick and vice versa. And so there is a high negative correlation between gold and the dollar. When one moves up, the other moves down and vice versa. And I think that relationship will not change.
Mm-hmm. Okay. And so of course, the other variable that we've talked about is real interest rates and inflation. Is it possible, Gary, that let's say we have the dollar weakening, or continue to weaken, but we have a sort of disinflationary environment where inflation doesn't really pick up? It hovered, well, it was at 4% the last reading, but that was year on year. The base reading last year was very low. People are expecting the annual inflation rate to tick down a little bit on the next release. But the point is it possible that we have conflicting forces here, maybe a disinflationary environment and a weaker dollar? In that case, what would have the stronger pull?
Well, right now, honestly, I do not see inflation ticking down in any dramatic manner. In other words, a major change to a lower inflation rate. The real costs of goods have gone up. Oil is at not record territory, but it's got more bullish sentiment than it's had in quite some time. It's maintaining a high price point. That's something that is looked at closely when it comes to inflation. If you go into a supermarket, food costs are tremendously higher than they have been last year or the year before that. And those costs result to real inflationary pressures. And I don't see that changing in any short period of time.
All right, let's take a look at silver now, Gary. As you know, silver very closely follows gold in terms of its price pattern. What can you tell us about silver's recent moves?
Well, if you even take a look at today's action, it hit a high of about $28. There's some real resistance at that price point. A lot of people are talking about silver pushing through $30. It has not been able to do that except on short blips or occasions over the last, say, 6 months. I do not see silver in terms of percentage gains equaling what we're seeing in gold, which is interesting because typically when gold and silver are running in tandem to the upside, silver outperforms gold in terms of percentage gains. The reciprocal is also true, and that is when they're running in tandem to lower pricing, silver sells off on a percentage basis greater than gold. However, in this recent rally in gold, we haven't seen silver perform quite as stellar as it has in the past in terms of that relationship. And so I think that what is happening is they're looking at gold as a real safe haven investment to protect against inflation, where not so much with silver. So while there's still a correlation, while they still tend to move either in tandem to the upside or down, we're not seeing the kind of strength that we've seen in gold, because gold's breaking to new highs that we haven't seen since the beginning of the year, whereas silver has been stalling at $30 before and now at $28.
Yeah, why is that? Can you attribute it to any fundamental forces behind this lukewarm activity? It is interesting because silver historically, like you said, silver historically outperforms gold during periods of upwards price movement in bull market periods. And of course, silver also has the industrial component. One would assume that silver would do very well during an infrastructure rebuilding program. That's just not what we're seeing. It's very strange.
Exactly. I think that what we're seeing is a disconnect between futures or paper prices and physical silver. Because while silver might be at $28, when investors go to buy a silver round or a 10-ounce bar, the premiums is what we've seen explode. At Kitco, I'm sure you're well aware of that. It becomes more and more difficult to get silver rounds, to get the bars in for delivery to consumers and investors that want them. And so what we've seen is a big explosion in the price of the premium of silver as opposed to the price of the commodity itself. And I find that very interesting.
The premiums are observable in bars and coins and retail products, but industrialists using silver are not buying bars and coins and retail products. They're buying either refined ores or raw ores directly from the producer, and they're using it for whatever industrial end purpose that they have. So, do premiums still apply in that sense for the people actually, for the industrial companies using silver to construct stuff?
Well, the ones that are using that some are buying the ore, but a lot of them are buying the 1,000 and 5,000 ounce bars of silver to use in their refining process, especially for solar panels. There's a big need for silver to construct and to go solar or clean energy. So you're not seeing the premiums rise in the same way. They've maintained a small premium when you talk about the large institutional and manufacturing players, because if they're buying pure silver, they're buying 5,000 ounce bars, 1,000 ounce bars.
Okay. Interesting. Well, we'll follow up more on silver's moves. It is a curious thing you've observed. The other manufacturing story to discuss, of course, is copper. Copper has also seen tremendous moves. Let's take a look at the copper price chart and talk about the story behind the move up here. Tremendous move up from the start of the year. Of course, the infrastructure spending, the bills that have been proposed in the United States plays a part. Also, China is a major force behind the copper price move. What's happening in China, Gary? Tell us about the policies in China that may have impacted this move.
What is interesting about China is they produce a lot of copper. I think that they're one of the largest producers of copper, but yet they cannot meet their internal needs, and they're a mass importer of copper also. And so they have vowed to spend a lot of money on a fiscal stimulus program, not fiscal stimulus, but an infrastructure development program, and copper is going to be highly needed in that endeavor. So China is a huge player in terms of driving the price up because of how much they import, even though they are such a large producer at the same time. So they're taking a good percentage of the world's supply of copper and utilizing it for their infrastructure programs. And as such, it's put a big demand on it. Consider that, I think about a month ago, the commodity strategists at Bank of America we're predicting copper to go to 587 per pound, about 13,000 per metric ton, I think is the translation. A Canadian bank that was reported by Kitco News last week is calling for copper to go to $5.25 by the end of this year, first quarter of next year. So there's a lot of analysts that are looking for copper to be a slow and methodical rise as the usage continues to outweigh the supply. Because with copper, it is a simple supply and demand scenario in which the supply cannot keep up with the demand. And as long as that happens, the price is forced to go higher as less of it is available and more of it is desired.
I wonder if there is any relationship between the dollar weakness and the copper strength. Do you think that's, can we make any sort of attribution there?
I think that the big mover in copper is supply and demand, but the dollar does play into it because, again, we're pairing copper in terms of dollars per pound.
Yeah.
And so you're going to get that relationship. You have to. But you've got that relationship coupled with the fact that the supply is diminished compared to the increasing demand, considering the copper, what at the beginning of the year was pretty much half the value. I think at around $2.50, $3 a pound, and now it's at $4.66 a pound. That's a tremendous rise in a year. That's like gold going from $1,000 to $2,000 or $1,200 to $2,000 in a single year. That's a huge, huge jump. And I think it is demand driven as well as the dollar adding a little bit, maybe more than a little bit of tailwinds to keep pressure on that price continuing to rise. I personally think that copper will reach at least $5 a pound by the end of the year.
Wow. Okay. So that that partly answers my last question. Your favorite metal of the three we discussed today, copper, silver, and gold, which do you think will have the most upside? Just doing the math on your your forecast, I'm guessing copper, but I'll let you answer the question.
Well, I think that there's a unique spot for both gold and copper as having stellar performances throughout the year. Now, it's kind of, again, the tortoise and the hare, where copper's move, if you look at that chart, has been a steady uptick week after week, month after month, and to some degree, year to last year to this year. When you look at the retracements in copper, they're shallow, they're minor, and they're short-lived. So we're seeing that price increase, and when profits are being taken, we're not really seeing tremendous pullbacks. We're not seeing a 5% or 7% pullback in the price of copper. We have seen those kinds of pullbacks in gold and certainly in silver. So long term, I think that they both have a place for the investor. And I think that there is profit potential in both of those. There's a key difference, of course. You're not going to sit with 2,500 pounds of copper in your vault or your safe. It's just not going to happen. So it's really going to be paper driven, whereas gold, you're getting a lot of investment dollars that want physical gold. They want to store it themselves. And so that's a minute difference that you are seeing in those two metals. And the other one is obvious. One is a precious metal. The other one is an industrial metal. And the thing about that is that gold, in terms of supply and demand, there aren't really big supply issues. There are in copper.
Fantastic. Gary Wagner of the editor of... One more time on that closing. Wow. Count me down, please. Sorry. Fantastic. Gary Wagner, editor of thegoldforecast.com, joined us right now to discuss metals. Thank you very much, Gary. That was excellent. Excellent update as always.
My pleasure as always to be here, and happy summer to all of our viewers.
Indeed, it's getting warm. Trading months are looking, less favorable compared to the beach. But we'll be following up with you and your trades very closely over the next few months. Thank you very much, and thank you for watching Kitco News. Stay tuned for more.